Book 3. How to determine the position of stocks. Read, not to contradict and confute, nor to believe and take for granted, nor to find talk and discourse, but to weigh and consider. Francis Bacon. A man has to buy and sell to make a profit. That is, he has to get in right and get out right. Then he must watch for the proper time to start his trade and the proper time to close it. Getting in right is not help if you fail to get out right. The time to act either when buying or selling must be determined by the condition of the market at the time and by the position of the individual stocks that you intend to trade in. You might be able to buy and make profits in some stocks after a bull campaign has about finished, while others you might be able to sell short and make profits after the major swing of a bear market has finished. This is fully explained under the chapters How to Tell the Stocks in Strongest Position and How to Tell when Stocks are in Weak Position. Do not buy a stock of one group just because some stock in another group goes up. Neither sell a stock of the same group because someone of that group has already started down. Analyze the position of the stock you intend to trade in. Find out if it has passed out of the accumulation or distribution zone. Stop to think before you act. Look before you leap. Examine before you buy and remember that it is always better to be safe than sorry. It is much better to take a small loss quickly than to hold on and hope and take a big one later. Chapter 16. Position of groups of stocks. It is very important to watch the position of the different groups of stocks. To be a success, you must keep up with the times and follow the leaders. The way to do this is to keep up a monthly high and low chart on several stocks of each different group. Also keep a yearly chart of the different stocks. The further back you have records, the better you will be able to judge the position of a group. Many years ago, traction and railroad stocks were the leaders. Then followed the copper boom. After that, the motors, rubbers, and oil stocks. Of course, every few years some kind of a boom develops in different mining stocks. But they are a class of stocks which you have to be very careful of, as they are probably the most uncertain of all. During the past few years, the man who stuck to rails has made very little money because the opportunities have not been there. The motors, rubbers, and oils have been the stocks which have made wide fluctuations and offered unusual opportunities for trading. The day of railroads is passing, and the big fortunes will not be made in them in future. Competition is getting keener every day in the motor industry, and it will eventually narrow down to a big return on invested money, but will not produce enormous profits. For this reason, you must be wide awake, and in the future look to the new things which will offer unusual opportunities and attract speculators, causing wide fluctuations. In future, you must watch for the new industries that develop and get into their stocks. Just the same as the people who left rails alone and got into motors and made a fortune. Those who sold out coppers in 1916 and played the oils in 1918 and 1919 made fortunes. In my judgment, the aeroplane and radio stocks will be the ones in the next few years that will make fortunes as great as any that have been made in oils or motors. The chemical stocks also offer great opportunities in future, as this country has made great progress along chemical lines since the war, and the business is growing on an enormous scale. A wide range is what the trader requires in order to make big profits. As long as stocks move between 20 to 100 points each year, you certainly will be able to make some money on the long or short side, probably both. But when they narrow down to 5 and 10 points in a year, your chances are very much against big profits. In 1916, copper stocks reached the highest level that they had made for many years. But in 1919, when oils and industrial stocks reached the highest level in their history, coppers only had a moderate rally. After that, they worked lower each year until 1920 and 1921. By keeping a chart of this group and some of the leading issues, you will be able to see that in 1919 the copper stocks had been heavily distributed because they failed to rally to the 1916 level. Therefore, they were good short sales for a long decline. Chapter 17. General Trend of the Market. There is always a certain group of stocks which will follow the general trend up or down, while others for a long time will work opposite to the general trend. The Dow Jones 20 rails and 20 industrials for many years past have been the best guide for the main swings, but since the number of stocks listed on the New York Stock Exchange have increased from 100 to over 700, naturally there must be a large number of stocks which will follow their individual trend and not the general trend of the market. Therefore, it is necessary to make a close study of the individual stocks and determine their trends regardless of the trend of the general market. An example of this kind occurred in the decline in October and November 1922. When all of the active leaders like Baldwin, Crucible Steel, Studebaker, and U.S. Steel were declining rapidly, Continental Can was advancing almost every day. Look at chart number 44 on Continental Can and see the different position it was in as compared to Baldwin Locomotive and other stocks. It had made a new high level and showed plainly that its trend was up, which it would follow regardless of the trend of the general market. I have explained this in regard to stocks that are leg movers and those that finish before and after final accumulation or distribution is completed. While you could have been selling Baldwin Locomotive, Crucible Steel, and other leading stocks and making big profits in the decline of November 1922, at the same time you could have been making big profits by buying Continental Can. Many traders foolishly sold Continental Can because it looked high, was advancing and paid no dividend. This was in direct violation of my rule to always sell the weak stocks and buy the strong ones, which is really following the trend of each individual stock. By watching closely the daily high and low, weekly and monthly charts, you will be able to determine when each individual stock has changed its position from strong to weak. Chapter 18. How to tell the stocks in strongest position. If you are waiting for an indication to buy stocks, you want to select the strongest stock in a certain group. As the stock which is in the strongest position is naturally the one that will lead in a bull market, and the one in weakest position will lead in a bear market. Studebaker. Suppose in 1920 or 1921 you were watching and waiting to buy one of the motor stocks. Note that the low price on Studebaker in 1917 was 34. Again in 1918 low 34. The high in 1919 was 152. It declined to 38 in December 1920, holding 4 points above the support levels of 1917 and 1918, which showed that it was in a strong position. However, the general group of motor stocks in the spring of 1921 did not show any sure signs of having made bottom, but Studebaker led the advance. It made 93 in April 1921, then followed the decline in May, June, July, and August, which carried all the motor stocks to new low levels. However, Studebaker, in August 1921, when final bottom was reached in the general list, was still selling at 65, up 27 points from the low of December 1920, while other motor stocks were lower than they had sold in 1920 or the early part of 1921. This was a plain indication that Studebaker was receiving strong support. Otherwise, it could not gain 27 points, while others were losing. It remained in a quiet, narrow range from 65 to 72 for several weeks, showing plainly that it was well supported and being accumulated. If you had been waiting to buy again, this would be the time. After that, Studebaker worked up, making higher tops and higher bottoms each month, as shown on chart number 2 on May 16, 1922. The low price of the reaction was 114 1/4. On June 12, 1922, low price 116 5/8. Then on August 11, 1922, the low of the reaction was 123. Again on September 29, 1922, low 123 7/8, showing progressive bottoms. On November 27, 1922, it declined to 114 1/4, the same support level of May 11 and 16, 1922, from which it rallied to 141 3/4 in December, the highest of the year. A 25% stock dividend was declared in November 1922, and as the stock had been placed on a 10% dividend basis in July 1922, besides an extra dividend of $1.50, it was only natural to suppose that this was the last good news which the stock had discounted. After it sold ex-stock dividend in December 1922, it declined to 110 3/8, breaking all previous support levels and indicating that the trend had turned down. Therefore, should be sold short on all rallies. It may remain in a distributing range for several months before it starts on a long decline. But this writing shows plain enough that it is going lower. Railroad stocks. On chart No. 1, which shows the yearly high and low of the 20 railroad stocks, you will notice that the extreme high price was made in 1906, and that after the 1907 panic stocks rallied in 1909 within a few points of the highest level. After that, they continued to work lower. In 1916 and 1919, when industrial stocks made the highest prices in history, as you can see by the chart, railroad stocks only made feeble rallies. In fact, after the rally in 1916, rails made lower bottoms and lower tops every year until June 1921. After the average low price on rails in June 1921, they continued to advance, reaching 77 in December, which was the high of the year, as you can see from the chart. In January 1922, they reacted to 73, then advanced to 78 in March 1922, which was higher than the level of 1921, and the first time that average prices had made a higher top on the yearly chart since 1916. In fact, in 1916, the rally was only 4 points above the 1915 high, and the big trend on railroad stocks was really down from 1909 to 1921. So, when finally they made a new high, it was a sure indication that the trend had turned and that they were going higher. They advanced to 93 on averages in October 1922, where they met with a resistance of the same high prices of 1918 and 1919. Now, suppose in 1921 that you knew rails must reach bottom sometime, and were watching to find the strongest bond to buy. Refer to New York Central chart number 5. NY Central. It is an old stock, and you can get its record for a long number of years back, and see how it established zones of accumulation and distribution. In 1893, low 90, 1896, low 88, 1907, low 89, 1908, low 91/8. This shows strong support between 88 and 90, and that the stock had been bought around these levels in panicky depressions over a period of 15 years. In 1914, it broke 88 and declined to 77. Now, after breaking the support of such a long number of years, it was a plain indication that the stock was going lower and that it should be sold short, and that you should watch for a new base of support before buying again. In 1917, railroad stocks declined below the panic price of 1914 and 1907. In fact, the averages reached the lowest they had been for nearly 20 years. The government was forced to take over the railroads in order to handle business on account of the war. In December 1917, New York Central made a low 63. In February 1920, low 65. In June 1921, it again sold at 65, showing that for 4 years it had received support at the same levels. Yet, during 1920 and 1921, Southern Pacific, Great Northern PFD, Northern Pacific, Norfolk and Western, Missouri Pacific, or BASH PFD, and many other railroad stocks had sold lower than they had for many years. New York Central held up, although the averages of rails were several points lower than the panic price of 1917. This was another opportunity to buy with a stop 3 points under the old base of 63. The high price made between 1917 and 1921 was 84. After being accumulated between 65 and 75, the stock crossed 84 in March 1922. This was a signal for much higher prices, and if you wanted to pyramid, should buy more at this level. It advanced to 101 in October 1922, where distribution started and then began making lower bottoms, showing that the trend had turned down. St. Paul. Another rail that made lower prices every year from 1909 until 1921. It has shown accumulation for some time, and at this writing both the common and preferred stocks now indicate that they are on the upward trend. Rock Island made a low price of 16 in December 1917 and has been making higher prices each year. Note how it led the advance in 1922 and made a new high. This is the way to select the stocks to buy. the ones that will not go down, and make higher bottoms in years of depression, will certainly lead the advance when the turn comes. Southern Railway, another stock that is now in a very strong position, has made higher bottoms ever since 1913 and still indicates higher prices. Union Pacific, low with the panic of 1907 was 100. In 1917, low 102. Another stock that you had a chance to buy at the old support level. February 1920, low 110. June 1921, low 111. A still higher support, and the place to buy with a stop-loss order under 110. You can see that Union Pacific made higher supports on each big decline from 1907 to 1921, while numbers of other railroad stocks were reaching new low levels all of these years, which showed that they were in a weak position and without much support. Union Pacific rallied to 154 in September 1922, where distribution started. Buying and selling points. You follow this same rule in any group of stocks in order to locate the strongest or weakest individual stock of the group. When you have the record of a stock for a long number of years back and see where it gets its support in extreme panic years and where it meets with resistance in boom years, you can easily tell the levels where it is safe to buy or sell with a risk limited to 2 or 3 points. American Gann. The low in July 1914 was 20. It advanced to 68 in October 1915, declined to 51 in 1916, then advanced to 68, the same top, where it held for several months without going higher, giving you a chance to sell out and go short. It declined to 30 in the panky break of 1917 and advanced to 68 in September 1919, where it held for nearly 2 months without advancing into new territory. This was another opportunity to sell out and go short with a stop 3 points above the old level. It declined to 22 in December 1920, which was 2 points above the support level in 1914. It rallied to 32 and again in June 1921 declined to 24, receiving support at a higher level. Then remained for 4 months between 24 to 29, showing plainly that the stock was being accumulated. You could then have bought again around these levels. In the fall of 1922 it crossed 68, the old resistance levels, which was an indication for higher prices, and you should buy more. American Loco. In December 1920, low 74, rallied to 91 in May 1921, declined to 74 in June 1921, receiving support at the same level and giving you an opportunity to buy with a stop under the old base. It advanced to 117 in April 1922, which was the high price made in October 1919. At this level you should have sold out and gone short with a stop-loss order at 120, or 3 points above the top. It then declined to 109 and held for several weeks in a narrow range, failing to break the support level around 108, which was made in March and April 1922. In August 1922, it made 118, crossing the old levels and indicating higher prices. It advanced to 136 in October 1922, where it met with heavy selling and the trend reversed. In November 1922, declined to 116, which was the old resistance level of October 1919 and April and May 1922. A stock nearly always gets support the first time it reacts back to old high levels, and the main trend would be considered up as long as it stayed above old resistance levels. Chapter 19: How to tell when stocks are in weak position. You always want to know the stocks that are in the weakest position, because they are the safest to sell short in a bear market. The ones that show weakness first naturally will be leaders in a bear market. After the trend turns down from the top, and stocks have declined for quite a while, the next thing which will show that a bigger decline will take place is the breaking of important support points. Industrial alcohol started up from a low price of 15 a share in January 1915, advanced to 170 in April 1916. Again in 1917 advanced to 171, and in May 1919 advanced to 167. declined to 120 in August 1919, and made the last advance to 164 in October 1919. Notice on chart No. 6 that the selling zone from 167 to 171 extended over a period of 4 years. Now, notice the support points. December 1916 low 95. November 1917 low 99. December 1918 low 96. December 1919 low 98. This stock showed distribution and that it was in a weak position, because in 1919, when industrial stocks reached the highest average in history, this stock failed to reach its previous high levels made in 1916 and 1917. Therefore, it was getting in position for a big decline. When it broke the support of 95 to 99, it declined to 78, then rallied to 102, and continued to work lower until November 1921. Yet, many other stocks made low prices in December 1920 and in June and August 1921. But industrial alcohol declined to 35. So, you see what enormous profits can be made on the short side if you pick the stocks that are in the weakest position and continue to follow them down as long as the trend continues to show lower. Notice how many times you could have bought the stock between 196 and how many times you could have sold it around 165 to 170, making profits every time on both the long and short sides. Then, finally, when the support around 96 was broken, it declined 5 points more. Again, I remind you that stocks are never too low to sell as long as the trend is down, and never too high to buy as long as the trend is up. After industrial alcohol reached 35, it remained for about 2 months in a 5 or 6 point range, and since that time has been making higher tops and higher bottoms. It reached 72 in October 1922, and as this stock was one of the last to make low prices in 1921, it will naturally be one of the last to complete its upward swing. If you had been short of this stock in June or August 1921, when other stocks made bottom, there would have been no reason for covering, as it was making lower prices every month and showing plainly that the trend was down. You should at least have waited to cover until it made a higher price than a previous month, which would have been 4-2, when it went over the high price of December 1921, Atlantic Gulf and West Indies, another stock which had a phenomenal rise in the bull campaign of 1919. Notice that its support levels in 1917 and 1918 were between 88 and 92. You could have bought it around these levels numbers of times and sold it out with profits of 15 to 20 points. It had a top or resistance level from 1917 until the early part of 1919 between 117 to 120, where you could always have sold it and gone short. It declined to 92 in February 1919. The previous low price was 89 made in December 1917. This was the place to buy, protected with a stop under the old support levels. It advanced and in April 1919 crossed 120, which was an indication for much higher prices. In May 1919 it crossed the high of its history, 147, advanced to 188 in June, reacted to 140 in August, advanced to 192 in October 1919. After that it began making lower bottoms and lower tops. In February 1920 it declined to 137, rallied to 176 in April 1920, where it again was distributed for several months, finally breaking the support of 137 and continuing the decline, the rallies getting smaller all the time. In November 1920 it broke through the supports at 92 and 88, which left no other support level except the low price of 27 made in 1916. It declined to 62 in December 1920, and while other stocks were rallying in January 1921, it continued on down, finally declining to 18 in June 1921. After making bottom for 2 months at 19, it started to rally. Advanced to 36 in December 1921, reacted to 24 in February 1922, holding for several weeks at this higher support point. Advanced to 43 in May 1922. then declined to 19 in January 1923, where it was again supported, and you should buy with a stop 2 to 3 points under. Thus, you can see how safe it is to sell a stock and keep short of it as long as it shows weakness, regardless of what other stocks are doing. Chapter 20. Judging final tops and bottoms. Before any stock or group of stocks starts on a big advance or decline, a long period of time is required for preparation or accumulation or distribution. It requires time to prepare and lay the foundation for a building. The larger the building, the more time required to construct the foundation. It is the same with stocks. The greater the advance or the decline, the more time required in preparing for it. For example, US Steel. Take US Steel, which was incorporated February 1901. It was a new stock and the largest corporation of its kind in the world at that time. Its common stock was all water. And as water seeks its level, Steel Common with its 5 million shares of water had to seek its level. It required many years to reach that level. The stock declined from 55 in 1901 down to 838 in 1904. When it reached the level of 12, it remained from December 1903 to September 1904, fluctuating between 12 and 838. Most of the time, the fluctuations were between 9 and 10. It was at very low ebb, slow, narrow fluctuations with very small volume of sales. This is where accumulation took place, which required about 10 months and gave you ample time to watch it and see that it was receiving support. You did not have to be in a hurry about buying, as it was preparing for its long advance. We will overlook the top at 94.78 in 1909. However, you can look it up for yourself and see that the entire capital stock changed hands several times between 88 and 94, and some days the trading in this stock alone ran over 500,000 shares, which of course showed that it was being distributed. Now, look at the final top in November 1916 on chart No7, when it reached 129 3/4. There was a wide range of fluctuations and big volume. It declined to 101 in December 1916, rallied to 115 in January and early February 1917, and on February 3, 1917, when the Germans declared the U-boat war, it declined to 99, which was only 2 points under the December low. Then the advance started, which carried it up to 136.58 in May 1917. The volume around this top was over 15 million shares, or 3 times the total capital stock. Note the 3-point chart, which shows how active it was and how it was moving up and down while distribution was taking place. The distribution of this stock was really going on from October 1916 until May and June 1917. Therefore, the man who wanted to sell out and go short had plenty of time to watch the stock and determine when distribution had been completed. It was getting ready for a long decline, but had advanced 98 points from its extreme low level of 1914, and it required time to distribute it. But note after distribution was completed, how rapidly it declined, reaching 80 in December 1917. The general impression among the public is that as steel goes, so the market goes. That is, they feel that US Steel is the leader, either up or down. There was a time when it was the leader, but it is not now. The majority of stocks made high prices in October and November 1916, and were at much lower levels in May 1917. Yet US Steel went 7 points higher in May 1917 than the high of November 1916. People who bought other stocks, expecting them to follow the lead of US Steel and make higher prices than in 1916, got badly fooled and lost their money. This is another illustration and proof of my rule. Do not buy stocks of a different group because some other stock is strong. General Motors and Studebaker. Trade in the stock that gives the strong or weak indication. Do not try to pick one to follow it. Judge each stock according to its individual position, by time, space, and volume. Do not expect General Motors to have a big advance because Studebaker has already advanced. Look up General Motors' chart and note its position. Also consider that it has a capital stock of 50 million shares, while Studebaker has only 750,000 shares. Don't forget it requires buying power to put a market up and selling pressure to put it down. It requires a much larger buying power to move a stock with several million shares than it does one with only 750,000. Did you ever stop to consider that with a stock like General Motors, each point up or down means a gain or loss of $50 million on the total capital stock? This is why so much buying and selling occurs at every point and why it moves so slow. When General Motors increased its stock in 1920 and issued 10 for 1, the price was 4 to 2 in March 1920, which equaled the value of $420 per share for the old stock. A slow decline started. It reached 13 in December 1920, which was nearly 30 points down in 9 months' time. This big decline was produced because of 50 million shares. There was no pool that was willing and had the money to support it. It continued to decline until it reached the low price of 8 in January 1922, then advanced to 15 in June 1922. This advance of 7 points seemed very small compared with what Studebaker and other motor stocks were doing. Yet, the percentage was just as great. Studebaker advanced from a low of 6 to 5 in 1921 to a high of 141 in 1922, which was a little over 100% increase on its selling price, and General Motors advanced from 8 to 15, nearly 100% on its selling price. So many people get fooled in buying low-priced stocks and simply hope and expect them to advance in points almost proportionate to a high-priced stock. Low-priced stocks do advance and decline in proportion to high-priced stocks, and even greater at times, when you figure the percentage on the price at which they are selling. American Smelting and Refining. Note chart number 8 on American Smelting and Refining, and the long period of accumulation from September 1901 to May 1904, when it made a range from 37 to 52. Now, when once it broke out of this range of accumulation, it was a plain indication that the advance would last for a long time, and that it would be a big one. It advanced to 174, never having any big reaction. It reached the high price in January 1906. Then distribution started, which lasted for a year. It fluctuated between 174 and 138, and finally, in January 1907, broke under the distribution point of 138 and declined rapidly, reaching 56 in February 1908. Thus you see that after great activity and a long time, a narrow or wide range at top or bottom, a big move follows in which you can make profits rapidly. Then how foolish it is for anyone to try to buck the trend or to hold on and hope when stocks start to go against them. Suppose that when the advance in this stock started, you sold short around 50 because it was near the old high price. When it crossed 52, it plainly showed up because it was in new territory. Suppose you decided to wait for a reaction to cover your shorts, which reaction did not come. The stock advanced to 62, 72, 82, 92, and on up to 174. What good would margin do? You would simply be throwing your money away, because you would be bucking the trend. Again, let us suppose that you started selling short at 100 and try to average, as so many people foolishly do. You would have been ruined. The same thing applies to the man who bought the stock around 138 in early 1907, and it declined to 56. What chance would he have, trying to average or by buying the stock outright and paying for it? He never would have gotten out. Just go over records of stocks for as many years back as you like and study them, and you will find out that it does not pay to buck the trend or try to average. The proper way to trade is to go with the trend and pyramid while you are making profits, and not when the market is going against you. I reiterate, stop your losses quickly and let your profits run. Progressive tops and bottoms. It always pays to keep a chart of averages of any group of stocks, as you can then judge when they have reached a level where they are receiving support or being distributed. But of course, you cannot trade in averages. Therefore, must keep a chart of some of the individual issues of each group in order to determine the best ones to trade in and the right time to buy or sell. On active stocks, 5 to 10 point moves will help to show when tops or bottoms are being made. On stocks, selling 25 to 60 per share 3-point charts will show best, but on stocks selling 100 to 300 per share 5 and 10-point moves are much better because it requires a wider range in which to buy or sell a large amount of stock. Sometimes stocks require several years to lay a foundation for a big bull or bear campaign. Suppose you were keeping oil stocks in 1913 and were watching for something which would lead an oil boom when it developed. Take California Pete. The low in 1913 was 16, 1915 low of 8, 1916 low 16, 1917 low 11, at which price it remained in a narrow range for about 4 months, showing that the stock was receiving support at a higher level than the low price of 1915. Having declined from 7 to 2 a share, the high price in 1912, it had shown accumulation between 16 and 8 from 1913 to 1917. It advanced to 56 in 1919, declined to 15 in November 1920, and advanced to 71 in July 1922. This is what we call progressive bottoms, i.e., each support several years apart being higher. 1915 support 8, 1917 support 11, 1920 support 15, and in 1921 low 30. As long as the stock makes higher bottoms and higher tops, the trend is up and it is safe to follow the advance. This rule applies to daily, weekly, monthly, or yearly movements. Mexican Pete. Another example of progressive bottoms or higher support. In 1913 low 42, 1914 low 51, 1917 low 67, 1918 low 79. In October, 1918 made its first big advance to a new high and reached 264 in October 1919, declined to 84.5 in August 1921, making a still higher bottom than the last bottom in 1918. So you see, all of these years Mexican Pete was receiving support at higher levels, which showed that it was preparing to reach extreme high levels before distribution would take place. Look up in the same way any stock you are interested in or wish to trade in and note its position over a long number of years. The larger the accumulation or distribution, and the more time consumed at top or bottom, the greater the advance or decline will be. As an example, see chart number 9 on corn products sold at 28 when it was first incorporated in 1906. It declined to 8 in 1907, advanced to 26 in June 1909, declined to 10 in 1912, advanced to 22 in 1913, declined to 8 in 1913, rallied to 13 in 1914, declined to 7 in July 1914. It remained in a narrow range and did not sell above 10 until the spring of 1915. It was first supported at 8 in 1907, again at 8 in 1913, and on the extreme more scarce sold at 7 in 1914, and showed a long period of accumulation. 28 had been the high of its history, which price was made in 1906. It crossed this level in 1917. This was a period of 10 years that the stock had ranged most of the time between 20 and 8, showing a long period of accumulation, and getting into new high territory showed that it was in position for a big advance. In 1919 it advanced to 99, declined to 77, then advanced to 105. In December, 1920 declined to 61, rallied to 76 in March 1921, then declined to 59 in June 1921, receiving support 2 points lower than the previous level. Then it advanced to 134 in October 1922. Thus, you see that after the stock crossed its high level for 10 years, it became more active than ever, never reacted below 24, and steadily advanced to 105 in 1920, the reactions being very small and every bottom higher, and showing plain indication of the upward trend. It is just as important to determine where stocks reach top or distributing zones in order to sell out and go short as it is to find accumulation and the bottoms at which to buy. Refer to chart number 3 on US rubber. US rubber. Notice that it reached 138 in June 1919, made the same high in July, made 137 in August. Again, in October made 138. In November 139, and in December 1919 made 138. During all this time, the bottoms had been between 111 and 117. The stock was finally rushed up to a new high of 143 in January 1920 and quickly broke back, which was an indication that distribution had been completed and that it was ready to start on the long decline. It began making lower tops and lower bottoms every month, but when it broke through 111, it showed that all support had been withdrawn and that distribution had been completed. The stock declined to 41 in August 1921. Its support points from 1914 to 1917 had been between 44 and 45. You might ask why certain stocks reach levels over a long number of years where they meet with support or resistance. The reason is that the same men manipulate these stocks. They are usually on the inside and know something about their value. Therefore, they buy them around a certain level and hold until they reach a level which they consider high enough. Then sell out and go short or wait until they decline to around the same levels again, where they buy for another campaign. You should study very carefully the stock that you trade in order to determine what its past points of support and resistance have been. The signs of a change. When you see the clouds gather, you know that it is a sign of rain, and you seek shelter, because experience has taught you that certain formations of clouds invariably indicate rain or storm. When you see the same signs in the stock market that have always meant distribution in the past, you should take it as your warning, stand from under, and protect yourself against the decline. Likewise, when you see the same kind of bottoms that have always indicated accumulation, you should cover shorts and buy. You judge a tree by the fruit it bears. In stocks, you must judge each by its own signs and signals, and not by what other stocks do. When you get an indication and the time comes to buy or sell, place your order at the market. Do not limit buying or selling prices. This often causes losses because you miss your market by an eighth or a quarter, and thus lose big profits. When it is time to get in or out, never quibble over a fraction. Do not lose points by trying to save an eighth. Chapter 21. Number of times a stock fluctuates over the same range. Very active stocks, and those that are high-priced, when they reach a level where the insiders want to unload, make rapid moves up and down for several months over a wide range, which causes traders to buy and sell because there are unusual opportunities. The stock remains around the high level long enough for them to become accustomed to the price and feel safe enough to buy. Suppose that a stock has advanced 20 or 30 points straight up, without much reaction, and it reaches top. It cannot be distributed in one day, 1 week, or 1 month, but the sure sign of accumulation or distribution is a stock moving up or down many times over the same range, especially making moves of 5 points or more without getting above its high point, and at the same time not breaking under its resistance levels on the downside. Sometimes a stock will move over the same range anywhere from 10 to 20 times, working up and down. Note Studebaker in 1922 and industrial alcohol, US rubber, and American woolen in 1919. You will see how they fluctuated up and down over a wide range while distribution was taking place. Studebaker moved up and down over the same range over 20 times between 114 and 139 between May and November 1922. The big swings up and down over this same range were only 5 or 6 times, but counting 5-point moves or more, it covered the same territory over 20 times. That showed that distribution was taking place, and that it was preparing for a long move down. When to stay out and watch. If you have been successful and followed a bull campaign up for many months and accumulated a big line of profits, you must be on your guard for the first real indication of a change in trend and the end of the bull campaign. When you get this sign of the end, which, as I have explained, is larger volume and rapid, feverish fluctuations, then get out, watch and wait. That is, sell out your long stocks and wait for the opportunity to go short. Never be in a hurry to get in again once you are out with a good profit. Opportunities always come again in the stock market if you only have the patience to wait for them. Another time when you should get out and watch is after the first signs are shown that a bear market is culminating. It takes time to accumulate stocks, and you do not want to get in too soon. If you have made big profits on the way down, you can afford to wait a few weeks or months until the signs are plain that another bull market is starting. Inside information. Wide fluctuations occur more often at high levels than at low levels, because distribution is taking place. When stocks reach very low levels after a final drive, they slow down and often work for some time in a very narrow range while accumulation is taking place. Accumulation and distribution are exactly opposite. When the insiders want to sell stocks, they make all the noise possible and do everything to attract the attention of the public and create a large public buying power. When stocks decline to low levels and they want to accumulate a large line, they work just as quietly as possible. They use every means to disguise the fact that they are buying stocks and do everything to discourage the outsiders from buying them. There is nothing wrong in the tactics employed by manipulators. It is simply business policy, and you would pursue the same policy if you were in the same position. They must buy stocks from someone, and they want to buy them as cheap as they can. Then you cannot expect the fellow on the inside, if he is honest and working for his own interest, to tell you that he is buying. Neither can you expect, when stocks get near the top and he is selling, that he will tell you that he is selling out, because he thinks they are high enough. He would be a fool if he did, because in order to cash in and get his profits, he must sell stocks to someone. So many people believe the only way to make money in the stock market is by getting inside information. I can tell you, after 20 years' experience, that inside information is impossible. And the sooner you get the idea out of your head that inside information will help you, the better off you will be. If you were playing poker with a man, would you expect him to show you his hand, and not expect to see yours? He certainly would not, and you know that he would not. If he did, you would win all his money. Then, why do you expect the man on the inside, whether he be a banker, pool manager, manipulator, investor, or otherwise, to tell you what he is doing when he is trying to make a market to sell out a line of stocks or to accumulate a line? You may be able to find out what he is doing if you can interpret the tape correctly, because it tells the story of everybody's buying and selling, and it never lies if you know how to read it right. For neither the insiders nor the outsiders can hide or disguise the amount of buying or selling. Every share bought or sold is registered on the tape. If you know how to correctly analyze the volume of sales and space movements, you will be able to tell when to buy and sell. The most important thing of all is the time factor, which I use in making up my annual forecasts. It is not my object here to give away that secret, but I am showing you plain enough and giving you rules enough that, if you follow them, you will be able to make a success in the stock market. The price you pay for this book means nothing. One idea that I give you may be worth thousands of dollars to you in the next 5 to 10 years' time, if you will only follow it. If I only succeed in teaching you how to avoid losing your money for the first 3 to 5 years, and you can keep even and get experience, then there is no estimating the value of this knowledge, for after a few years' experience and study, you will then be able to make money rapidly. Chapter 22. Crossing Old Levels. When stocks establish certain levels of accumulation or distribution over a long number of months or years, and then cross them is almost a sure sign that they are going to new high or low levels before they meet with resistance again. As a rule, it is always safe to buy or sell a stock around old bottoms or tops with a stop-loss order 3 points above or below previous high or low prices. For example, see chart number 10 on Republic Steel. Republic Steel. In 1916 the high was 93, 1917 high 94, 1918 high 96. It was a sale every time it reached these levels. In 1919 it crossed 96 and advanced to 104, then reacted to 81, crossed 96 the second time and advanced to 145. A stock going into new high territory, the second time is always safer to buy than the first time, as the first time it goes through it is likely to meet with a lot of selling to drive it back. But the second time the stock has all been absorbed, and it is easy for it to advance. Note from 1914 to 1919 the bottoms were progressive or higher on Republic Steel, or Bash PFT. But December 1916 high 60, worked lower each year, making lower bottoms and lower tops until December 1920, when it reached 17. It ranged between 18 and 24 all during 1921, while accumulation was taking place. Declined to 20 in August 1921, making another higher bottom, and sold at 20 every month from August 1921 to February 1922. Here was a strong indication of support, and you should buy the stock with stop at 18, and buy more when it crossed the high price at 24 made in 1921. It advanced to 34 in April 1922, which was the old resistance level of October 1920. Distribution took place, and it declined to 23 in December 1922, receiving support and remaining in a 2-point range for several weeks, then started upward again. In studying the different groups of stocks, you should watch the position of each individual stock to see which one is in position to lead an advance or decline. Crucible Steel started its big advance in 1915 and made 109.78. It made lower tops in 1916, 1917 and 1918. The bottom in 1916 was 51. In 1917 low 46, 1918 low 52. When the stop crossed the high price of 1918, it was an indication for a further advance, and when in 1919 it had crossed the top of its history, 109.78 made in 1915, it was a sure indication that it was going to make extreme high prices. The fact that it held around 46 to 52 for 3 different years on declines showed accumulation. Crucible advanced to 278 in 1920, which of course was an extreme price and not based on intrinsic value. Therefore, after doubling the capital, it suffered an extreme decline back to 49 in August 1921, where it was again in its old zone of bottoms and was a purchase for another advance. Cutting and increasing dividends. I have stated before that you should never sell stocks just because they do not pay dividends, nor buy them because they do. In December 1921, Crucible advanced to 69. It was then paying 4%. It declined to 53 on February 27, 1922. Early in March, the dividend was passed, when the stock was selling around 58. It declined to 53.5 and failed to break the low price made before the dividend was passed. This was an indication that the passing of the dividend had been discounted, and that if the stock could hold above the levels previously established, it was a purchase regardless of dividends. It advanced to 98 in September 1922, which was the level from which the last break started in 1921. Around this time, a new issue of stock was offered to stockholders at $100 per share. This caused selling the old stock and reversed trend, the stock declining to 59 in November 1922. Always watch a stock when new stock is offered at price around which the old stock is selling. If the old stock fails to get higher than the price at which the new stock is offered, it is an indication of good selling, and you should sell out and go short. United Retail. Another instance of the effect of dividend reduction is United Retail Stores. The low price made in December 1920 was 46. The stock rallied to 62 in May 1921. Declined to 47 in August 1921, again receiving higher support. It advanced to 57 in January 1922 and showed every evidence of having been accumulated for the past year. In February 1922, when the stock was selling around 53, the dividend was cut and it declined to 44. Now, if you had bought around the old level of 1920, 46, and placed a stop 3 points away, or at 43, it would never have been caught. During March 1922, the low was 44 and the high 47, a 3-point range for a month, which showed that the stock was being supported. It opened at 45 in April. Then the advance started. Suppose you had waited until it crossed the high price, made in March, and bought at 48. In a little over 30 days after that time, the stock advanced to 71. After reacting 10 points, continued on up to 87 in October 1922, the old resistance level of 1920, where it met with heavy selling, and declined to 66 in December 1922, another resistance level. This shows you that the insiders knew a long time before the dividend was cut it was going to be cut, and they were buying the stock. Now, all you had to do was to wait and see if they would give it support around the previous low level. After they had held it for 2 months without permitting it to break 3 points under the old bottom, it certainly was safe enough for you to buy and risk 3 points on. In many instances when dividends are cut, it is the time to buy, as the worst is known and has been discounted. As a rule, when dividends are increased and extra dividends paid, the insiders are distributing stock and they bring out the good news in order to entice the public into buying. I could cite you hundreds of instances, but one example will suffice. US Steel advanced to 136.58, the high of its history, in May 1917. It was paying 5% dividend. The dividend was then increased, or an extra dividend paid, which equaled 17%. But the stock never sold as high again and declined to 71/4 in 1921, because the insiders knew that the earnings were the best they probably would ever be, and it was the time to bring out the good news and facilitate distribution of the stock. Book values. Another thing I wish to call your attention to that misleads many an investor is book values. Statisticians had figured the book value of US Steel at around $250 a share in 1917, and of course, the poor suckers who bought it at the top thought it would go there. As far as the advance in price is concerned, book values mean nothing, because the company is not going to be liquidated. Therefore, the book value is only good to create false hopes and make people buy and hold on, thinking that the stock should sell somewhere near its book value. Not one stock in 100 ever sells anywhere near the book value. In February 1915, US Steel passed its dividend. The stock was selling around 40. It declined to 38 and has never sold lower since. That was the time to buy a real bargain, not when it paid 17% and sold above 130. In 1915, the high on US Steel was 89. In January 1916, low 80. Again March and April 1916, low 80. The stock held in a range of 9 points for 9 months, and in August 1916 advanced to 90, which was above the high price of the previous year. After holding for so long a narrow range, it was a sure indication of a big advance, because the stock had been accumulated. Otherwise, it would have declined below 80. It advanced to 129 without reacting 5 points. After the high price of 136.58 in May 1917, it declined to 80, the low price made in 1916, where it received support. According to the rule, you would have bought with a stop 3 points away, or a 77. It advanced to 116 in August 1918, remained 2 months around 116, which showed that distribution was taking place and that you should sell out and go short with a stop 2 or 3 points above 116. It declined to 89 in January and February 1919, remained for 2 months in a very narrow range without breaking the bottom of the previous month. Here was another chance to buy with a stop 2 or 3 points under the old bottom. The stock advanced to 115 in July 1919, failing by 1 point to reach the 1918 top. Here you should sell out and go short again with a stop above the old levels. The stock continued on the downtrend, and in 1920 broke the bottom of 89 made in 1919, and also broke the support points at 80 made in 1916 and 1917, which showed that support had been withdrawn and that it was going lower. It declined to 70.14 in June 1921, remained in a narrow range during July and August, fluctuating between 72 and 76. This showed that accumulation was taking place and that you should buy with a stop-loss order under 70, or buy as soon as the stock crossed the levels made for 2 months, which showed that the trend had again turned up. It advanced to 111 in October 1922, where it reached the distributing zone of 1919 and 1920. At this writing, it shows that distribution is taking place and the stock is getting ready for another downward move before the end of 1923. You should always study each individual stock separately and learn how to follow its moves. No two work just exactly alike. Neither do all stocks make tops and bottoms at the same time, but they do show plainly when they are in a strong or a weak position, and you will be able to judge the position of a stock in each different group by making up a monthly high and low chart for several years back, when stocks make new highs or lows. When a stock advances or declines into new territory or to prices which it has not reached for months or years, it shows that the force or driving power is working in that direction. It is the same principle as any other force which has been restrained and breaks out. Water may be held back by a dam, but if it breaks through the dam, you would know that it would continue downward until it reached another dam, or some obstruction or resistance which would stop it. Therefore, it is very important to watch old levels of stocks. The longer the time that elapses between the breaking into new territory, the greater the move you can expect, because the accumulative energy over a long period naturally will produce a larger movement than if it only accumulated during a short period of time. 1921 high prices. 1921 was low year of the Depression. Although there was a strong rally up to May 1921, most stocks made low prices in June and August 1921. Now just look up a list of stocks and see the ones that crossed the high prices made in the early part of 1921. They are the ones that led the 1922 bull market and had the biggest advances, while stocks that failed to make the highs of 1921 are yet selling at low levels. January 1923. Following are some examples of stocks that made new highs. Alice Chalmers, 1921 high 39, advanced to 59 in 1922. American Gann, 1921 high 32, advanced to 76 in 1922. When it crossed 68, it was in new territory for its history and indicated much higher prices. Up to this writing in 1923, it has advanced to 84. American Smelting, 1921 high 44, advanced to 67 in 1922. American Woolen, 1921 high 82, advanced to 105 in 1922. Atchison, 1920 and 1921 high 90, crossed this price in 1922 and advanced to 108 in September 1922. Baldwin, 1921 high 200, advanced to 142 in 1922. Canadian Pacific, 1920 and 1921 high 129, crossed it in February 1922 and advanced to 151 in September 1922. Chile Copper, 1921 high 16, 1922 high 29. Coca-Cola, 1919 high 45, 1920 high 40, 1921 high 43. Crossed all of these highs in the early part of 1922 and advanced to 82. Continental Can, 1919 high 103, 1920 high 98, 1922 high 68. Crossed all of these highs and advanced to 124 in 1922. Great Northern PFD, 1921 high 79, crossed in 1922 and advanced to 95. L&N, 1921 high 118, crossed in 1922 and advanced to 144. New York Central, 1921 high 76, crossed in 1922 and advanced to 101. Pan Pete, 1921 high 79, advanced to 100 in 1922. Sinclair Oil, 1921 high 28, advanced to 38 in 1922. Studebaker, 1921 high 93, crossed it in January 1922 and advanced to 141. US Cast IP, 1921 high 19, advanced to 39 in 1922. US Steel, 1922 high 88, advanced to 111 in 1922. Thus you see that all of the stocks which crossed the high of May 1921 early in 1922 had big advances because they were in strong position, and the buying power being strong enough to carry them over the previous year's highs showed that they were going higher. Stocks that did not cross 1921 highs in 1922. You will note that the stocks which did not show strength in the early part of 1922 and were unable to advance anywhere near or cross 1921 highs, have proved to be laggards and are still selling at comparatively low levels up to this writing. This again proves my rule to buy the strong ones and sell the weak ones, and do not let the price at which they are selling prejudice your judgment, as the stock that is selling the highest will often continue to advance, while those that are selling low will continue to decline. The following stocks failed to cross the highs of 1921 during 1922. Note the levels at which they are now selling. January 1923. American Agricultural Chemical. 1921 high 50, selling at 32 at the end of 1922. American International. 1921 high 53, selling around 26 at the end of 1922. American Linseed. 1921 high 60, selling at 32 at the end of 1922. American Sumatra Tobacco. 1921 high 88. Although this stock is a late mover and did not make bottom until after the other stocks, it was still selling around 28 at the end of 1922, which is near low levels. Atlantic Gulf. May 1921 high 44, selling at 22 at the end of 1922. Chandler Motors. 1921 high 85, 1922 high 79, selling at 65 at the end of 1922. International Paper. 1921 high 73, selling around 52 at the end of 1922. Pierce Arrow Common Preferred. Hive 1921, 41 and 49 respectively, both selling at low levels at the end of 1922. United Drug. 1921 high 105, did not rally above 84 in 1922. U.S. Industrial Alcohol. 1921 high 74. It was a late mover and did not make bottom until November 1921, but only rallied to 72 in 1922 and failed to cross 1921 top. Virginia Carolina Chemical. 1921 high 42, selling at 25 at the end of 1922. Worthington Pump. 1921 high 55, declines to a new low level, 27, in November 1922. You see that Pierce Arrow, Chandler, and General Motors all failed to make 1921 highs, and at the end of 1922 were selling at low levels, while Studebaker, which made a new high in the early part of 1922, was selling at a high level in December 1922. General Asphalt 1921 high 78, rallied to 73 in 1922 and failing to reach the high of 1921, show that it was meeting with heavy selling, because it remained a long time around high levels, then declined to lower prices than it made in 1921. This is the thing to watch. When stocks advance near old high levels and remain a long time and fail to go through, distribution is taking place, and as soon as they break out of the distributing zone, they should be sold short. Traders who bought asphalt, expecting it to follow Pacific Oil, Mexican and Pan Pete, suffered big losses because the other stocks showed that they were in strong position, while General Asphalt showed that it was in weak position. The rubber and sugar stocks all failed to cross the high prices of 1921, and at the end of 1922 were selling at lower levels. The rubber stocks have recently, January 1923, started to advance, and if they cross the high levels of 1921 and 1922, they will then indicate higher prices and may continue to advance while other groups of stocks decline. Then, you should buy rubbers and not sell them, expecting them to follow stocks which made high levels and were distributed during 1922. Buying or selling after a stock shows change in trend. After accumulation or distribution takes place, a stock moves into new territory, either high or low, showing that the stock has been absorbed or distributed and that a new move is starting. Refer to chart No. 9 on corn products. Note that after the stock halted at 108 and remained for several weeks in a narrow range, while it was being absorbed between 106 and 108, fluctuations were very narrow, and you would not be able to make much money trading in it. But if you bought it after it crossed 108, which showed that the trend had again turned up, you would have been able to make 20 points profit in less than 60 days. Now, The same condition will develop in the opposite direction. Since September 1922, the stock has been holding for over 4 months between 124 and 134, and you would only be able to make small profits trading in and out. After it breaks 124, it will show plainly that the trend has turned down, and if you sell short then, you no doubt will be able to make quick profits. The big profits are made in the runs between accumulation and distribution. Therefore, you make more money by waiting until the stock plainly declares its trend than by getting in before it starts. It is just like a race. It often takes 15 or 20 minutes to get the horses away from the post. But once they are off, the race is over in 2 minutes. It is the getting ready that takes the time. The run is soon made, once the firing line is crossed. What difference does it make whether you buy stock 10, 20 or 30 points above the bottom, so long as you make profits? The same with selling short. It makes no difference how much the price is down from the top. When it breaks out of the distributing zone, it is a safe short sale, and you will make quick profits. Get the idea of prices out of your head. Forget about the bottoms and tops. Trade to make profits, not to try and catch the bottom or top eighth. The insiders do not do it, and you cannot hope to do better than the man who makes the market. Chapter 23. Tops and Bottoms on Railroad Stocks. In another chapter, I have told you about stocks and groups of stocks which are leaders, and you should always follow the leaders, either up or down. From 1896 to 1909, the railroad stocks were the leaders, and banks discriminated against industrial stocks and loans and accepted the rails as gilt-edged securities. Note on chart number 11 the low price of the Dow Jones 20 rails was 4-2 in August 1896. After a long advance, they made the first important top in April, 1,899, when prices reached 87, although they were within 1 to 2 points of this same level in February and March. A big reaction occurred in May, which carried prices down to 78. A rally followed in September, bringing prices up to 86, within 1 point of the April top. They met with stubborn resistance at this level and declined to 73 in December, 1,899, then rallied to 82 in April 1900, and again in June declined to 73, making a double bottom or reaching the same prices made in December. After this double bottom, a big advance started, which did not culminate until May 1901, when prices reached 118. On May 9, 1901, the Northern Pacific corner took place, which caused a panicky decline, average prices declining to 103. This was the first sudden big break in the bull market and showed that it was over for the present, and that you should then watch for a rally to sell on. A rally followed in the latter part of May and in June, carrying prices near the top of May, then a decline to 105, where prices held for 4 months, just above the level made in the May panic. Here accumulation took place again, while stocks were moving over a narrow range. Then followed a long slow advance to September 1902, when prices reached 129, where they made a sharp top, which was followed by a rapid decline to 89 in September 1903. Note that accumulation occurred from September 1903 to June 1904, at which time the bull market was resumed. Stocks rallied to 127 in April 1905, this price being within 2 points of the high level of September 1902. A rapid decline carried prices down to 115 in June. Then they advanced to 138 in January 1906, which was the highest in history, and averages were up 96 points in 10 years. Prices started to decline, and following the San Francisco earthquake, declined to 120 in May 1906. Then they advanced to 138 in September, making the same top as in January. They remained around this same level with fluctuations narrow until January 1907, when they broke out of the distributing zone, and after such a long period of advancing markets, with distribution which had lasted for over a year, it was but natural that a drastic decline should follow. A silent panic occurred on March 14, 1907, carrying prices down to 98. This was one of the most rapid declines that has ever occurred on the stock exchange. After this, a sharp rally followed. Then another decline, bringing prices down to around the low levels of March 14, and in some cases, stocks selling lower. After this, the market rallied and held up until August, but was very dull in the rallies, which showed that liquidation had not been completed. Liquidation started again in September 1907, and finally wound up with a panicky decline in November, when the averages reached 82, which was 56 points down from the high of the early part of the year. Accumulation took place until March 1908, when the bull market started again, which culminated in October 1909 with prices at 134, within 4 points of the highest in history. Here they met with resistance, and distribution took place over a narrow range, lasting about 6 months. The decline started in 1910, and wound up with a sharp break in July, which carried the averages to 106. This was a sharp bottom, and prices rebounded quickly. They continued upward until July 1911, when the averages reached 124. Then fluctuations became narrow at the top, and the market was very inactive for several months. A sharp decline occurred in August and September, carrying prices down to 110. Then followed a slow advance to August 1912, when prices reached 124, the same top as 1911. Here they made a flat top from August to October 1912, then declined to 100 in June 1913. The market was narrow and inactive, and slowly worked up to 110, making a slightly lower level than April 1913. There was a small rally and a narrow market in May and June 1914, and in the early part of July the big decline started, which wound up with a big break after the war broke out and caused the stock exchange to close on July 30th. The exchange opened again on December 15, 1914, and the averages declined to 87 in December. They remained in a narrow range around the same level until March 1915. Here an advance started, and prices reached 108 in November 1915, finally working up to 112 in October 1916. Note that this was the year of distribution in the rails, and that they only got 3 points higher in 1916 than the top of 1915, while industrials at the same time were having a big advance because war conditions were favoring industrials and working against the rails. 1917 was a year of big declines and great liquidation in the rails. Prices made the lowest for many years, declining to 71 in December, when the government was forced to take over the railroads, which brought about a sharp rally in stocks. The averages advanced to 93 in November 1918. Then came the end of the war, and they declined to 81 in January 1919. Then followed the greatest industrial boom in the history of Wall Street, but rails failed to have any big advances, and only reached 92 in July and August, which was 1 point lower than the high prices of 1918, while industrial stocks advanced over 20 points higher than the 1918 prices, because industrials were now leaders and the rails were the laggards. In February 1920, the rails declined to a new low level, making 68. After this, the rails and industrials began to work closer together. The rails rallied to 85 in November 1920. Then followed a long decline which carried them down to 66 in June 1921, which was the lowest price at which the averages had sold since 1897. From this level, they advanced to 93 in August 1922, which was the same top made in 1918. They remained at this same level during August, September, and October 1922, holding in a narrow range while distribution was taking place. In November, they broke out of the distributing zone and declined to 82 on November 27. Since that time, they have rallied to around 87, January 1923, where they are very dead and inactive and meet selling on every rally. Every indication now seems to point to liquidation, but the proper thing to do is to wait and see whether they become active and advance above the level of 86 or start activity on the downside and break under the level of 82 made in November. It is my opinion that before rails cross the 1922 highs again, they will sell at very much lower prices. Chapter 24. Bottoms and Tops on Industrial Stock. Chart number 12 shows the tops and bottoms on the Dow Jones 20 Industrials from 1896 to December 1922. Note that the low in August 1896 was 29. They rallied to 77 in April, 1,899, where distribution started, declined to 68 in May, then rallied to 77 in September, 1,899, making a double top, declined to 71 in October, rallied to 76 in November, failing to make the old top by 1 point. This was really a triple top, and failing to cross it showed big distribution and indicated a long decline to follow. Prices declined to 58 in December, then rallied to 68, which was the bottom of the distributing zone. In 1903, during November and December, prices declined to 42.5, then rallied to 50 in January 1904 and held in a 4-point range until June. They show that accumulation was taking place and that stocks were getting ready to advance, although at this time railroad stocks were the leaders. In July 1904, the advance started and continued, subject to minor interruptions, until January 1906, where final top was made, prices reaching 103. This was a sharp top, and a decline followed, bringing prices down to 86 in July 1906. They rallied to 96 in August and remained around the same level in a 4-point range for about 6 months, until January 1907. This showed big distribution in a narrow range, and the long length of time indicated a big decline to follow. 1907 was a bare year in industrials as well as rails, and they declined to 53 in November, making a sharp bottom, as you will see from the chart. After this followed the long advance to the top in August 1909. The industrials were now becoming more prominent and were assuming the leadership over rails. Prices reached 100 in August, making a flat top, holding the same level for 6 months while distribution was taking place. A decline started in January 1910. Prices reached the low of 74 in July 1910. Then followed a slow rally, making top in July 1911, and at the top the market remained for 2 months, very narrow and inactive, while distribution was taking place. You have often heard it said, never sell a dead market. But you must consider whether prices are near the top or bottom when they become dead. If they get very narrow and dead near the top, it is a sign of decreased buying power, and only a question of time when something will occur to cause buyers to become sellers and force stocks down. The break started in August and declined to 73 in September 1911, making a double bottom. Then followed the slow advance to October 1912, the first top being made in June, and the market holding about 6 months for distribution. Then followed a decline to June 1913, when averages reached 73, making a triple bottom, or practically the same level as 1910 and 1911. In 1914, the top was made from February until July, in a very narrow market. Stocks would rally and become dead and inactive, which showed that the buying power was not there, and that liquidation was taking place. In the early part of July, the decline started. Activity was on the downside, and prices broke under the distributing level. The exchange closed July 30, and when it opened in December, prices declined to 53, making the same level as in 1907, or a double bottom, although it was 7 years apart. Prices fluctuated in a narrow range until the spring of 1915, when the industrial stocks led the advance, with war babies coming to the front every day. The averages reached 99 in December 1915, which was the first top in the Great War boom. They declined to April 1916, making 85. Here accumulation took place, and they rallied rapidly to November 1916, when the averages reached a new high for their history, 110. From this top, there was a sharp decline, and the real distribution took place under 100, or after stocks were down 10 points from high levels. I have explained something in regard to this in a previous chapter, about where sharp tops are made and distribution takes place after the first big decline. In 1917, prices declined and reached the first low, 87, in February. They rallied from this level, but were very inactive on the rallies. Stocks looked very cheap when compared to the high levels of 1916, and the public bought them. The decline continued during 1917 and bottom was reached in December, prices making 66. This was a sharp bottom. Then accumulation occurred after prices were up 10 points. The chart will show you that the accumulation took place between 76 and 84. So you see that the same rule applies. Distribution takes place below the level of sharp tops and accumulation several points above the level of sharp bottoms. 1918 was a year of narrow fluctuations. Prices had advanced to 88 in November 1918 when peace was declared. Then followed a quick decline to 80, where you will see that prices held for 4 months in a 4-point range, making the same low level every month. This was the second stage of accumulation and showed that it was getting ready for a big advance, which started in February 1919. You will find my annual forecast for 1919 in the back of this book. You can see how accurately I foretold the big advance in oil stocks and industrials for that year. 1919 recorded one of the greatest advances in the history of the stock exchange, the industrial stocks rising nearly 40 points on averages in 9 months' time. Of course, many individual stocks had advanced from 50 to 150 points. The volume of sales was the greatest of any year on the stock exchange, the average daily sales running close to 2 million shares per day during August, September, and October. In the early part of November, the advance culminated with a sharp top. There had been only 2 reactions during the year, one occurring in June and the other in August. Distribution took place on the way up, because the public was buying stocks regardless of price, name, previous condition, or future possibilities. They were buying on hope, believing that the bull market would never end, but it did, suddenly and unexpectedly, as all highly manipulated market movements do. A panicky decline followed in November 1919, and prices declined to around 103. They rallied and held in a narrow range, making 109 in January 1920. A second period of distribution took place in January, which was followed by a severe decline in February, carrying prices down to 90. In April, the Supreme Court handed down the decision declaring stock dividends non-taxable. This caused another wild wave of speculation, with many companies declaring stock dividends and the public buying everything on hope. The averages reached 105, and from this level, the long decline started, which continued until December 21, 1920, winding up with a 3 million share day, and the averages at 67, the same level as they made in 1917. Read my annual forecast in the back of the book, and see how accurately I foretold the 1920 market and forecasted the panicky decline to the exact date. After this decline, a sharp rally followed to May 1921, when prices reached 81. The market became slow and dead at the top, showing that the supply of stocks was greater than the demand. Liquidation broke out again around the 10th of May, and prices continued to decline until liquidation was completed in August and averages had reached 64. This was the third zone below normal, or the zone of extreme depression, and the place for accumulation and buying. It was exactly opposite to the feverish zone of distribution of October 1919. After the August 1921 break, a slow rally started. See my 1921 stock forecast in the back of this book. It called the exact top for May and the bottom in August 1921. Reactions were very small and stocks continued upward to October 1922, when prices reached 103.42, where distribution started. The break which occurred in November 1922 carried prices down to 92, which was 4 points under the bottom of the distributing zone. My 1922 stock forecast, issued in December 1921, called final high for October to the exact date and predicted the decline for November 1922. You can see from the top that by January 1923, distribution has been going on for about 6 months. They rallied to just above 99 in January 1923, and it is the writer's opinion that the high prices made in October 1922, will not be exceeded by 3 points until averages decline to 75 or lower. Distribution will take place on every rally in the spring of 1923, and the fall of 1923 will witness panicky conditions in the stock market and drastic declines. Chapter 25. Accumulation of low-price stocks. If you go back over past history, you will find that most of the stocks that have sold at very high levels, i.e., anywhere from $100 to $300 per share, at some time in the early stage of their career have sold at very low levels, and that the accumulation of many stocks which have become leaders has taken place below $25 per share. For example, see chart number 9 on corn products. Corn products. In the Great Bull Market of 1906, corn products sold at 28, which was the high price of that year. In the bear market of 1907, it declined to 8. In the bull market of 1909, it advanced to 26, failing by 2 points to reach the high price made in 1906. In 1911, it declined to 10, and in 1912 it advanced to 22, again failing to reach the high level of 1909. In 1914, it declined to 7, which was the lowest in its history. In 1915, it recovered rapidly and advanced to 21. In 1916, it advanced to 29, which was the highest price of its history up to that time, and 1 point higher than the level of 1906. 1917 was a bear year, and many stocks sold lower than they had for many years, but corn products only reacted to 18, and before the end of 1917 had sold above 29, the highest of 1916. The stock being in new territory, and higher than it had sold for 10 years, showed that accumulation had been completed and that a big advance was likely. Therefore, the logical course to pursue was to follow the advance as long as the trend showed up. It advanced to 37 late in 1917, thus making a new high in a bear year, and showing that there was buying power enough to carry this stock up against the trend of the general market. Now, when a stock has never sold higher than a certain figure for a number of years, a lot of people think that when it reaches that level or gets any higher, that it is due for a reaction. This is a great mistake. 1918 was a year of irregularities and reactionary price movements. It could not be termed a bull year. Yet corn products advanced to 50. And when other stocks suffered a big decline in January and February 1919, this stock only reacted to 4 to 6, or 4 points from the high. Then the 1919 bull campaign started and corn products began to advance. It continued to make higher tops and higher bottoms, showing that demand was greater than supply, advancing to 99 in 1919, and in the spring of 1920 to 105. When it reached this level, if you look at a weekly and monthly chart, you will see that distribution started. In fact, it made a sharp top, reacted quickly to 88, then rallied to 97, where it showed weakness. After that, the trend was down, and it declined to 61 in December 1920, advanced to 76 in March 1921, declined to 59 in June 1921. The fact that it only declined 2 points below the low level made in 1920 and showed accumulation around this level, it could naturally be considered in strong bull position and should be bought with a stop under this low level. It advanced to 68, reacted to 64, held in a narrow range between 64 and 68, while accumulation was taking place during July and August 1921. Then the advance started. It continued upward with very little reactions until it reached 105, the high price of 1920. Of course, around this level it met with heavy selling, because a lot of people thought if it reached the highest price of its history, it was high enough. It advanced to 108 in March 1922, which was 3 points above the highest price made in 1920, and showed that somebody was still buying the stock, although it was meeting with heavy selling. It declined to 99 in May 1922, and around this level became very inactive and the volume of sales was very small, which showed that selling pressure was decreasing. It started to advance slowly and gradually began to make higher resistance levels, until in August 1922 it advanced above the high price of 108, made in March 1922. After 5 or 6 months' time, and only reacting 9 points, then making a new high level, showed plainly that the trend was up and that the stock should be bought and followed up as long as it showed an upward trend. It advanced to 134 during the week of October 21, 1922. After that it reacted to around 124. Then rallied 5 or 6 times up to around 132-133, but failed to make the high price of October 21st. It remained in this trading range between 134 and 124 from October 1922 until the date of this writing, January 12, 1923. This shows that it has reached a level where it is meeting with great resistance and heavy selling, and the proper thing to do is to be out of long stock and short. If it breaks under the level of 124, it will show plainly that distribution has been completed, and you should then follow the downward trend until it reaches a level where it meets with resistance and shows accumulation. Chapter 26. How to watch investments. A lot of people handle their investments the same as they do their health. They never consult a doctor until they are seriously ill. Then it may be too late, or the expense will be 10 times greater than if they had consulted a doctor and protected themselves against future ailments. No matter if you hold gilt-edge bonds or preferred stocks as an investment, they should be looked over by an expert at least once a year to see if there are any symptoms of weakness developing in the list. Investments should be sold out on the first sign of a change in conditions, and you should not wait until everybody is selling and you are forced to sell on a liquidating market. Very few people are willing to pay even $25 a year to have their investments looked over and receive real expert scientific advice. But after they have losses of thousands of dollars, and it is too late for expert advice to help them much, then they are willing to pay hundreds of dollars for helpful information. It is the old story of locking the stable door after the horse is stolen. French bonds. It is impossible for the best human judgment to pick a number of stocks or bonds that will all prove sound. It is also impossible to run any business without expense, and the expense in the investment business is occasionally taking a quick loss. When you find that one of your investments shows weakness, sell on the first indication. Do not hesitate. Many people bought French 7 1/2s and 8s above 100 because they pay 7 or 8%. The very fact that they pay an abnormal yield on investments should have shown the man who thinks that there was something wrong with the credit of the French government. Otherwise, they would not have to pay such high interest if their security was gilt-edge. When these bonds declined to 99, it was a danger signal, and they should have been sold out immediately. But many investors did not sell for the very reason that they yield a high return. Now the 8s have declined to 93 and the 7 1/2s around 89, and there is no prospect in sight for them going back to par anytime soon. So the man who bought because he received a higher return for his money now has a shrinkage in his capital of 7 to 10%, which eats up a lot of interest. Changing to speculative issues. It is always better to be safe than sorry. Many large estates have been wiped out because the younger generation refused to sell the investments that their fathers made and switch into something better just as soon as the investments began to show shrinkage. Many men leave fortunes to their wives in gilt-edge investments, which are paying 4 1/2 to 5 1/2%. They have bought them for safety, for the protection of principal, and not for large yield. A woman wants a large income so that she can live on it. She will sell out gilt-edge investments and buy speculative issues, because the return is large and often in a few years she finds herself not alone without an income, but with her capital half wiped out. The gambling instinct is so strong in human beings that they never look for safety until it is too late. They listen to the story of bond salesmen, get-rich-quick schemers who play on their hopes, and get them to change from safe investments into gambling speculative investments, and in 90% of the cases, the result is losses. Discrimination and investigation. At the present time, when we are in a reconstruction period after the greatest war the world has ever seen, discrimination is more necessary than ever, and every investor needs the service of an expert. Many people have the idea that if they buy bonds which are sold by J.P. Morgan & Co., Kuhn Loeb and Company, or the National City Bank, they are buying something gilt-edged and guaranteed. These banks are in the business of selling bonds for a commission. They do not guarantee them, but they do make money on every bond they sell. Yet, the buyer may never see a profit. The very best houses must sometimes handle issues which are unsound, and you must not buy bonds without investigating their merits just because they are sold by a house with a long-established reputation. The French government issues were all floated here by our highest-class bankers, but that has not prevented these bonds from shrinking in value, and the bankers who sold you the bonds made no guarantee that they would support the market and prevent a decline. Liberty bonds. The best securities are bound to shrink in value at times. It is a question of supply and demand. The US government is the soundest government in the world today, and it was at the end of the war in 1918. Then why did Liberty bonds decline to around 85? Because there were billions of them in the hands of the public, and when the Depression of 1920 and 1921 set in, the people were loaded with bonds and short of cash. Therefore, when they needed cash, the only way to get it was to sell Liberty bonds. The result was that everybody was sellers, and there were very few buyers, and bonds declined. When they had been absorbed at low levels by large investors, they gradually worked back to 100 again. Atchison. A lot of people have the idea that there is such a thing as investments being so good that they cannot decline. They forget the fact that supply and demand govern prices, and that there must be a buyer for every seller. If buyers are scarce and sellers are numerous, stocks or bonds go down. Suppose you were carrying Atchison Railway in 1915. It advanced to 111, reacted to around 105, rallied to around 108, where you can see from a chart it held during 1916 and part of 1917 without getting above this level. Here was an indication which showed plainly that the supply of the stock, after it made 111, was greater than the demand, and as the yield on the money invested was small compared to the high interest rate, the investor should have sold out Atchison and waited for a favorable opportunity to repurchase. On the break in the latter part of 1917, it declined to 7 to 5. During 1920, it held around 7 to 6, making the same level 4 or 5 times, which showed that it was receiving support and had reached a level where conditions were just opposite to what they were when the price was around 108. The demand was greater than the supply, and the stock stopped going down. After all the stock was absorbed at a low level, it started to advance and again reached 108 in September 1922, where it held for a short time without crossing the old level of 1916. This was the place to again sell out investments and wait. Atchison then declined to 98 in November 1922. When it reaches a level where the demand is greater than the supply, it will again be time to buy. This may be several years off yet. Value of expert advice. You should keep a chart of all of your investments. It requires but little time to keep up a monthly high and low chart, and it will show you when you should get out. If you are not sure of your own judgment, secure the services of a reliable expert whom you can depend upon. A lot of people feel that they cannot afford to pay out $100 to $200 each year for expert advice to protect their investments. If they would only look at it from a sensible standpoint, they would realize that they cannot afford to be without expert advice. Consider the price of my service, $100 per year for my annual forecast on stocks, together with a supplement issued once a month or more often. You have the privilege of asking my opinion at any time on any investment you hold and securing advice on how to switch your investments so that they will prove profitable and safe. The cost per year is 1 point on 100 shares of stock. Many people carry thousands of shares and let their investments shrink thousands of dollars, when by paying $100 per year for my service, they would be able to save hundreds of times the amount they pay me. Expert service works both ways. It not only protects you against loss, but helps you secure your profits at the right time. If you saw a plain indication that your health was breaking down, you would not wait until your case was hopeless, but would secure expert medical advice at once and be willing to pay a good price for it. Your investments, in one way, are more vital than your health, because if your investments shrink to a level where they cause you to worry, you are sure to undermine your health. I have seen hundreds of cases in Wall Street where men lost their money, then lost their health. Therefore, expert scientific advice performs a double service, provides protection for your health and your capital. In Wall Street, opportunities come more often than any other business, but you must have knowledge in order to recognize them. Opportunity. They do me wrong who say I come no more, when once I knock and fail to find you in. For every day I stand outside your door, and bid you wake and rise to fight and win. Wail not for precious chances pass away, weep not for golden ages on the wane. Each night I burn the records of the day. At sunrise every soul is born again. Laugh like a boy at splendors that have fled, to vanished joys be blind and deaf and dumb. My judgments seal the dead past with its dead, but never bind a moment yet to come. Though deep in mire wring not your hands and weep, I lend my arm to all who say, I can. No shame-faced outcast ever sank so deep, but yet might rise and be again a man. Dost thou behold thy lost youth all aghast? Dost reel from righteous retribution's blow? Then turn from blotted archives of the past, and find the future's pages white as snow. Art thou a mourner? Rise thee from thy spell. Art thou a sinner? Sins may be forgiven. Each morning gives thee wings to flee from hell, each night a star to guide thy feet to heaven. Walter Malone.